Welcome. This is the Lemonade second quarter 2024 preview video. It's going to be a bit of a monster video. We have all these tabs. We're going to walk through each one of these one by one. I hope it's going to be packed with a lot of value for you as we look towards this quarter to try and understand, is this kind of the rocket ship moment this quarter or not? So let's dive into it. We're gonna cover the loss ratio in a lot more depth than I think I ever have in previous videos. We're gonna give sort of a lot of expectations around, hey, what's IFP, customer count, premium per customer coming in, what's adjusted EBITDA gonna come in at, compare that to guidance. We're also gonna talk about, like just speculate. What might happen? Will the stock rise? Will it fall? Will it stay flat? We don't. No one knows that answer for sure. But give a little bit of speculation, or at least some thoughts there. Again, nothing on this channel is financial advice, but give those thoughts, and then finish off with, hey, a little bit of long-term perspective. Long-term perspective. What sort of we really hanging our hat on the thesis on, no matter what happens this quarter. So diving into it, starting off with the loss ratio. Let's talk about the loss ratio front and center, because some people maybe not realizing this, but hey, Q2 was really bad for some storms and catastrophic events, severe convective storms. This is from FT Partners. We believe loss ratios are likely too low given competitor results in a very active catastrophic quarter, severe convective storms. Okay, and if you let's look at what the consensus estimate ranges are for gross loss ratio, about 82-83%, all the way up to 95 as a high and down to 77% as low, but about 82-83%. So let's walk through my approach as the way I kind of thought through this. And it's by no means perfect, but I think it's less wrong. I'm not going to read through this. I'm just going to explain it. But this was something I tweeted out and wrote in my Lemonade Discord. If you want to pause the video, you can read this. You can also find it on Twitter. You can check that out. But just actually explaining it now in the spreadsheet, this is how I was calculating my Lemonade loss ratio, which I'm going to calculate. I'll tell you right now, it's 89%. And I mean, we don't know. There's a lot of uncertainty here, but it's roughly what I'm thinking. Maybe it's 89%, and the cat portion of that loss ratio being about 22%, and ex-cat maybe 67%. So how the heck did I get there? Let's back up a little bit. First of all, we have our gross loss ratios here for Lemonade, and then we have gross loss ratio ex-cat, and I called this adjusted ? Adjusted ? Because I actually adjusted some of these numbers. See, this was 72, 71, 70, 69, 68, but they're slightly different actually in reality, and especially last quarter it was actually 63%, not 68%. And this was pointed out in my Discord, said, hey, this was from Tim Bixby, said, regarding last quarter, it was 63%, but our prior period development was a roughly 6% favorable impact in the quarter. So that means there was losses previously not really fully accounted for, or they were maybe estimated in previous quarters, I should say. They were accounted for, but then they turned out to be not as bad as they thought, and so it turned into a suddenly more positive number. That's why you had gross loss ratio, ex-cat was in the 70s, and maybe stuck in the 70s when it should have been dropping sooner, and then suddenly dropped at 63%. I've kind of leveled out those numbers a little bit. That's why I'm calling it adjusted, just so it helps some of the modeling later, and it should be a little more accurate to what those quarters were actually like. Then based on those two figures, gross loss ratio ex-cat and the gross loss ratio, I can figure out Lemonade's cat loss ratio. But essentially, how much of the loss ratio was affected was due to catastrophic events. So I have that punched in here. That's easy to calculate up until last quarter. And then I figured out, hey, what's home? See, my sort of theory was the majority of your catastrophic losses are going to come from home. This is like my quick and easy way to say, how can we, there's a lot of information here you could sort of dive into and comb through and get really lost in the weeds. But I was thinking, okay, what's sort of the broad strokes? How can we figure this out or estimate this as simply as we can, but still accurately, or hopefully accurately. We'll see how accurate we are after the quarter comes out. So I thought, my theory was, most of what we're talking about is home. Of course, there are catastrophic factors that influence cars. So your cars get damaged by a storm, and you have car claims, that kind of thing. But generally, it's your property, it's your home insurance that has by far the biggest amount of effect from catastrophic events. So I want to focus on the home and figure, hey, if we can kind of solve the home factor, then we can kind of solve everything, or get close enough to solving everything. So first of all, I figured out, or I estimated, what percentage of the in-force premium is home. And back in Q3 2022 at Investor Day 1, we had there was 149 million of home IFP, and if you divide that by the total amount of IFP, you get 24%. So we're very confident in that number. About 24% of home was the case back then. Then we see here in 2023, we say on Q4 2024 letter, it said only 13% of new premiums were home. So you can do the math and kind of roughly calculate that again. And based on that percentage of 13% of new premiums, you can see that, hey, the percentage of home is dropping, which makes sense because less than 23% of new premiums being written as home. So then that means that average just slowly drops. So 24%, they have 23%. And then I assume, I don't know if we have data, not that I'm aware of or offhand, but into the next, last quarter and this upcoming quarter, I'm just estimating, hey, they continue to subtract home from the book, not writing aggressively home. I still not pushing that as a product really, really aggressively. So you get down to, I'm saying 21% of home is part of the total book of business. And then this was probably maybe the biggest guesstimate, sort of educated guess, is the percentage of catastrophic losses that are caused by home. So even though home's only 20-some%, I'm saying, hey, 80% of the catastrophic losses, I'm assuming. So again, a bit of a guess. I've played around with the numbers in a different range. Doesn't swing the numbers too wildly depending sort of what range you pick here, but 80% of your catastrophic losses are caused by home. That's what I'm assuming. Once you know that value, once you know the overall cat loss ratio, which is the number right here we had, and 80% is home, and the amount of the book of business is this amount, then you can plug in and calculate the home catastrophic loss ratio, home specific. So only within home, then you have this range of loss ratios here. So you say, so 20, 33 or of catastrophic loss ratio. So you can see here it kind of follows like Q2 of last year when we had a lot of convective storms, sort of tornadoes, that kind of thing. It was a bit of a surprise quarter. The loss ratio shot up to to 94% overall. I'm saying that the home cat portion, so none of the other portion, the non-cat or ex-cat, but only the home cat portion was 80%. I'm saying it's 80% in that quarter based on the analysis and the numbers we've put in. And that's really helpful. You can see that spike. It's 52, 30, 46, 29, 42, depending on the quarter. It can really tell us or show us, hone in on what's the home catastrophic portion of the loss ratio for Lemonade only. And the reason I wanted this number is because we have numbers from Progressive, and we have numbers, well, Allstate has some as well, but they haven't released Q2 numbers yet, so I never bothered with Allstate. But Progressive and Travelers, we have numbers for their home, sort of a similar, somewhat similar apples-to-apples comparison. It's, of course, never going to be a total apples-to-apples comparison, but it's somewhat similar because Progressive and Travelers, this is for their property catastrophic loss ratio and Travelers home catastrophic loss ratio. And the great thing is both of these line items here, we have a value already for Q2. So we can look at these and kind of correlate them. So I just put them into a graph, this line, and Lemonade's home, these three lines into the graph here. And then you can see it's not a terrible correlation. If you look at Lemonade's pink line, it sort of follows the blue and yellow somewhat similarly. Like Q2 especially of last year was again that poor quarter for catastrophic events, and there's a lot of correlation there. And now to Q2 this year, for example, for Progressive, they had a 75% catastrophic factor in their home business, and Travelers 48%. Well, I'm saying, Q2 a year ago, we were at 80%, 67, and 52%. So I'm saying similarly, Lemonade's probably improved their overall mix and book of business. Improved their home product a little bit by getting rid of some of the worst customers, but still I'm predicting it's going to be a bit higher than these, just kind of like this quarter. As you see on the graph, this quarter I'm similarly predicting, hey, maybe Lemonade's home catastrophic loss ratio is 85%. So that's the number I put in. That's the number I'm kind of guessing based on just looking at this graph and seeing how these numbers roughly correlate with each other. From that, you do the reverse of the calculations I did here, and you can then calculate the overall Lemonade catastrophic loss ratio is 22%. And then I'm predicting a gross loss ratio ex-cat adjusted of 67%. Now, again, last quarter was 63%, but just like Tim's comments, like we covered here, that 63% might have been a little bit artificially low. So I'm predicting maybe 68% 67% ex-cat, and then you add the 22% that we calculated. That arrives at an 89% gross loss ratio. So that's sort of my rough thinking analysis that I explain all here in this post. But overall, we're saying, hey, comparison to a year ago, Q2 a year ago is 94%. The book of business risk-wise should be improving overall. So now we're at 89%, about a 5%, that year-over-year comparison improvement in the gross loss ratio, which I think is a reasonable amount. And, ex-cat, you go from 71 to maybe 67%. And with the cat, 23%, 22% cat only. And now to sort of try to compare this quarter, Q2 of last year to Q2 of this year, we're going to look a little bit deeper here further at this. And just before we do that, just to give you some illustration, like Q2 was especially the month of May. These are Progressive's numbers because they release some of this data on a monthly basis. But for May specifically, on their property business for Progressive, their net catastrophe loss ratio, this is like, again, the effect of just net of catastrophes, was 173. 173. You see, like commercial was 0.9, personal lines total was 6. Like this was huge amounts. And it says it incurred mostly related to severe weather throughout the U.S. 3 events primarily impacted Texas and the Midwest, accounting for nearly 60% of the cat losses. So it was obviously a few really bad events or storms that caused a ton of damage, and you have this massive, massive spike in number here. This is the exact same report, but for June, you can see that the exact same number here, Progressive, for the month of June, we're at 17%. So way, way, way less. May was really, really bad. June, not so bad. Stickstrom, I'm not sure if I'm saying that right, but he's a great follow on Twitter. Or on X, he posted this little thread about loss ratios, and he pointed out from Lemonade's, it was their Q4 2023 letter, they had a whole section about loss ratios. They had a link to this website. We're going to go have a look at that website where it showed the National Center for Environmental Information. It shows a nice breakdown and a sort of a simple comparison you can do for disaster comparisons on a year-over-year basis. And so the first graph here is for the United States only. There's 2024 in this graph. Unfortunately, they don't have 2023 in this one. But you can see, the June 2024, June, May, and April, May, June, so Q2 is a little bit higher than the overall average. Now, I don't know if I trust this overall average line because this overall average is going all the way back to 1980. So even how, if you remember my interview with Daniel, even how catastrophic events are defined, the fact that they haven't been increasing the sort of minimum threshold for a catastrophic event over the years, even though inflation has been, marching along, would naturally mean that there's more sort of definition of catastrophic events happening. So it's hard to trust this versus the overall average, but you can see a rough idea of the whole United States of 2024 thus far. Now, if we take a look at Lemonade's 10K, you can see on page 144 of their 10K here, it says they have the geographical breakdown of gross written premiums. So you can see, hey, what is Lemonade writing per jurisdiction? You can see California is the most, Texas, New York, New Jersey, Illinois, Washington, Georgia, Colorado, Pennsylvania. All others is still a huge amount, 23%. But you see a bit of an idea of sort of where they're most concentrated. Of course, there's going to be a mix of how much home insurance especially is in each of these. They don't give a breakdown of that, which is too bad. But if we look at Texas, so Texas was one of the places had one of those bad storm events that Progressive mentioned. If we look at Texas for this year, which is nice because they have 2024 versus 2023. You can see 2024, the red line over April, May, June has been higher. So this year has been worse for these catastrophic events or disaster events versus the prior year when we had that really bad loss ratio, right? So it gives you a bit of a comparison. Hey, this is actually looking worse in Texas this year. Now, if we look at the central climate region, so all of these states, which I think would be, is sort of in the, would be considered the Midwest area, you can see that actually 2024, this is positive, has been better. Again, red line here is under the green line for April, May, June. So Q2 has been better in this area. Then if you look at California, it's basically there's nothing to report here at all in this for 2024. So that's great. And New York, very small. I mean, you're talking 500 to a billion range. So very, very small amounts. And again, they don't have a 2023 comparison. So it's tough to really compare those figures. But I point out that to say, I think this 89% is a reasonable number in our model versus 94% from the year prior. 94, just because the book of business should be overall improving, should be de-risking. That's where I'm putting the number in. Of course, it could be higher, it could be lower. Now, if you think about how will the market react to the gross loss ratio number specifically, because I think the market does have a lot of, this specific number has quite a bit of influence on how the stock might move immediately after earnings. And I covered this in a few videos ago where it was sort of an early Q2 preview of whether we would rocket, take off after earnings or drop. And this is looking out a year prior. It was very, very similar in July of last year. And then that 94% loss ratio hit us and boom, it's like, it was instantly the stock just started plummeting, went all the way down, major fall until the next earnings. And it was actually not so bad. Sky hadn't truly fallen and things were better now. But now we're doing a similar kind of retest and trying to decide, hey, is this going to continue and take off? My own theory is I think the market knows. I mean, it's interesting here. This post from FD Partners was saying they think it's actually are the likely too low from competitors, given competitor results. And they point out, gross loss ratio is 83%, but some people are expecting 95%. So my own thought is, again, 89%. I feel like if the market kind of is more aware and expecting, and from a year ago, expecting a little more trained to say, yeah, loss ratios are probably going to be higher, then my own thought is, hey, if it's in the 80s, it's maybe not that bad. And the market kind of says, yeah, you get a passing grade loss ratio. That's a check. If the loss ratio is 95 and my maths and assumptions here are way off, or 95% or something or higher, I think, we might have a repeat of where the stock slides suddenly. Hard to say. There's other factors at play here, which we'll cover a little bit here in the video, but that would be my own speculation and thought. But I feel like even 89% might be considered respectable or okay if you say, hey, ex-cat, we're continuing to improve, but this quarter was just, again, bad for catastrophic events. But we also are continuing to sort of, the underlying dynamics are continuing to improve. I feel like the market might give them a pass. At least that's my own sort of speculation. So I hope I'm even wrong on this. I hope we're even a little bit lower, which totally could be the case. But those are some thoughts around the sort of loss ratio, where it might come in. Now let's move on to the rest of the model and top line growth, where we think that might come in at. We know that Q2, Q3 of this year should be really good quarters for growth. Even just, it makes sense to typically tend to be, especially Q3, the best quarter for growth. There's also other signs like BJ23A or Transform Investing on X said, I've been tracking Lemonade monthly website data for 28 months. Over that period, June 2024 had the highest website visits, best global website rank, and best US website rank, and best finance insurance website rank. It's all really, really positive to, hey, there's eyeballs going to Lemonade and there's customers visiting them. Also, if you look at Lemonade insurance search, interest is rising. If you do a Google search, I'll actually pull up the actual search here. So within the US over the last 5 years, interest or Google trends for Lemonade and the insurance company were at 88% of the all-time high. And the all-time high would have came, this is back in like June, July of 2020 when Lemonade IPO'd. So when you IPO, there was tons of buzz about the company, the stock took off, lots of interest. People are just talking about searching for it. So you get obviously a huge sort of spike in interest, and then that drops as people don't care as much, right? But it's been trending up over time over the last, several years since. And right now we're near, I'd say we're at the highest point other than when it IPO'd. So it's very, very positive. Now, this is already in Q3. We're talking July right now. So this is talking about Q3 numbers, but Q2 still is also respectable. So I think this quarter, and especially Q3, we should have really good growth. So how I'm thinking about this is, first of all, think about the customer growth. And customer growth, I think about, the way I calculate it is I start with, what are they going to pay to acquire each customer? And I've gone a little more bearish, put $135 per customer in. The reason I'm doing that is because they're going to be spending more this year on acquiring customers. They have roughly a total of $110 million. They told us that, I think it was, in the Q4 letter of last year, that last year they spent about $55 million. 2024, they expect to spend about double that. So about $110 million we should expect to be spent this year on customer growth. Now, Q1, they spent $19.8 million. So I'm estimating, hey, Q3 is always the biggest by far in terms of customer growth. So I'm saying, hey, they're going to do huge Q3. We're seeing that in, some of the Google search interests rising right now. So I'm saying they're going to spend $45 million, for example, in Q3. Q2, I'm saying they're going to do better as well, a little better than Q1 or Q4, but $20 million in Q4. And then I'm saying, hey, $25 million in Q2. Together, that sums about $110 million roughly as you're spending. And, last year they spent your customer acquisition cost. Last year, if we flip over there, scroll down a little bit, your customer acquisition cost per customer, I'll zoom in, was more like, let's say over the last year specifically, was an average of $104 per customer. Really, really good. Like, that's really, really cheap. $104 per customer that they're acquiring. This year, I'm making it higher just because I'm saying, hey, if they're going to push growth that much harder, you're going to, first of all, last year, you had less growth spend, but you're going to acquire the lowest hanging fruit sort of customers first. And then if you double your growth span, it's going to become less and less efficient as you push more and more growth over, a certain span of time. And so I'm assuming, okay, maybe it's going to be a little bit higher for the rest of the year. $135 per customer is what I'm popping in there. So $135 for the rest of the year is my assumption. And then I have in here, I calculated the 12-month churn. That's I'm not going to go review all that, but number of customers in millions churning every 12 months. And then I've made that into quarterly numbers and essentially figured out, hey, how many if they're spending so much on customers and they're churning so much, how many net gained? You acquire so many, but then you're churning so many. What's the overall net change per quarter in customer counts? So you have 106,000 new customers Q2, 250,000 new customers Q3, so a monster quarter for growth, and then 64,000 customers in Q4. And it pop those numbers in at the top, adjust them so that they make sense, and you get to about 2.5 million customers. I mean, we just under 2.1 million at the end of Q1, 2.5 million customers by the end of the year is roughly kind of how I'm thinking about this quarter versus end of the year, right? Now, IFP, I also see, rather than trying to guess at what the premium per customer could be, I then separately calculate what the in-force premium is, and then see, hey, does the premium per customer change and values roughly make sense? Then it's sort of a cross check between how I did the customer count, how I did the overall premium count, and how the premium per customer is growing. So in-force premium, the way I'm thinking about it is, last year they said they expected to earn from rate increases about $100 million over this year. Maybe I think it was $100 million or even more. So I have $25 million per quarter being added to IFP just because, hey, rates are going up and those rates start to earn in. Then I'm saying, hey, this is a bit of a guess. I'm saying home, they're specifically, non-renewing some customers because they can't get rates adequate. They're not adequate enough yet, and regulators are still digging in their heels or dragging their feet, and so they're subtracting out some premium from just canceling home product. I don't know if it's going to be $5 million each quarter. That's all, a bit of a guess, but that's what I'm putting in. And then I'm guessing new customer average premium per customer. So I'm saying it's $315 per customer is what each new customer comes in the door with. Now, Q1 we had $379, but I'm saying, hey, they're going more in renters and more in pet and these lower premium products. So if right now across this year, the average premium per customer is $350. And then I have the customer 12-month churn at 16.6%, which I had previously calculated. Again, cover that in some other videos. We wrote the numbers each quarter. You get 850, 951, and 992 over the next 3 quarters for this year. And again, I plugged that into my model here for the IFP side of things. And then you can sort of cross-check your premium per customer, 2.7% growth, 1.9, 0.4 less growth that quarter, and then 1.7% and then it kind of matches even last year's growth. You had a bit more growth and then less growth, whereas you have a bigger amount of growth of customer count and then smaller amount of growth. So, you end the year at just under $400 per customer on average. And this number I expect to really scale. Haven't tweaked these 2025, 2026 numbers. That's for a whole nother video. But the amount of cross-selling should really increase starting next year as car, as home are more aggressively pushed to this, 2.5 million customers that they might have by the end of this year. But you got to wonder if they would be actually shooting for $1 billion in-force premium. And certainly if this number of 135 was too high, then easily they could still spend the same amount and they're going to get more customers for the, same amount of spend, and have higher customers and you'll have more premium then, and maybe easily shoot over that $1 billion mark. And then gross loss ratio for the next few quarters, 4Q 2, 3, 4 of this year. So 89% we already covered. But then I'm suggesting, hey, from rate increases, from inflation, you might be getting an ex-cat number of 66% and then 65% in Q3, Q4. And if you compare it to 2023, the cat effect was 10%, 5%. Say you'd have the exact same cat effect. Maybe you have 76%, 70% gross loss ratio Q3 and Q4 if that plays out. So you punch all those values in, you get some results for the end of the year. But anyways, customer churn, I have still staying steady at about 16.6%. That customer acquisition cost, we already covered that, 135. Sales and marketing fixed expenses, I've just sort of slightly increasing. They've been even decreasing or been very flat. As synthetics agents, I still expect them to be using about 80% of that program as much as they can through the end of the year. Other insurance, tech develop is just increasing 4% quarter over quarter. Tech development, I have it flat. G&A, I have it at flat. General and administrative expenses. Overall total expenses, you actually have this quarter, your expense ratio going from 53 to 52%, and then rising a bit in Q3 because they have so much of that expense for CAC or customer acquisition, and then dropping significantly in Q4 as they have a lot less of that customer acquisition cost probably coming in that quarter. Then so all in all, though, I have adjusted EBITDA this quarter, Q2, of $48 million loss. Q3, 51 with the values I've input here. I mean, you can really tweak these around. So Q3, actually, it's really interesting. I covered this again in the other video. It's like, depending on what they've guide for Q3, it might also, depending on what this loss ratio is for Q2 and then the guidance for Q3, there is a risk. I feel like those two factors, we could have sort of a plummeting stock. That's sort of my bearish take, is that, hey, the market doesn't like the loss ratio and the market doesn't like the Q3 guide, and then the stock falls. To me, that's definitely a possible scenario. Just something to be thinking about, something to be prepared for. But Q4, I do wonder if we get through Q3, and if it's a solid quarter, and then Q4, they guide for, like adjusted EBITDAs, they guide for 20 million, or when it's like an $18 million loss, it's like, whoa, like it could really tell the market, hey, we're drastically improving. Like last year, Q4 was a big surprise. They only had $29 million loss. So adjusted EBITDA. So that year we're saying like 18 million. Oh man, like Q4 results, I'm just speculating here, just sort of putting my speculator hat on. I know we're waiting for this rocket ship moment. I'm like, I wonder if it's going to come like either after Q3. I mean, it might come in Q2, might come next week. I really don't know. But it might also come after Q3 as the market sees the guidance for Q4 and kind of starts to realize what's coming. It might come in Q4 or after Q4, when they see how good of a quarter Q4 was, and then like maybe the guidance for the next year just is like really, really good. At least that's my theory, or at least my kind of thinking is that, hey, the market, it might wait till the end of 2025, which is totally possible, but also the market is always forward looking. And you kind of wonder if one of these quarters might be this one, but I would maybe, if I had to guess, I would think more likely after Q3 or after Q4. It's like things might get really, really interesting as the market realizes, hey, we're like the guidance for 2025 is just like really, really good guidance. But anyways, back to this quarter, adjusted EBITDA, we're at the minus 48 million. Let's just compare that to Lemonade's guidance. They're at that 47 to $49 million range, and they have a tendency to like always beat their guidance. So I'm actually thinking like maybe I'm a little too bearish. Like if anything, I feel like it might be a little too bearish, and maybe the 135 is actually a lower number, because that can have a pretty big effect. Like say that's 110. Well, now even for the same amount of customers that you want to get, now you suddenly drop to adjusted EBITDA of 43. So from that going to 135 to 110, now you're at almost 48. So it's like $5 million difference there, that one number. So, we're in that range though, and I think that we can at least make sense of this, right? And for 2024 as a whole, if we take the sum of the adjusted EBITDA, we're at, it's like $151 million loss. And that's like right at the sort of better end of their spectrum. So again, right is sort of in that guidance range, though maybe I'm a little bit off on some of these numbers and they could even be more positive. And again, just flipping back to FD Partners review, this is versus consensus estimates of adjusted EBITDA of like minus 50 to minus 47 to minus 39 kind of range. So, sort of closely within that range of what some people are expecting. Now, I talked a little bit already. Speculation, was the stock going to fall, and reasons it could fall, the loss ratio, adjusted EBITDA guidance for Q3. But if you think about other positive reasons, there seems to be this rally around small cap stocks. So the Russell 2000, right sort of in July here, took off from 2,000 up to, we're at 2260 right now. So this rally, and guys like Tom Lee, he thinks that this rally could continue over the summer and even a Trump presidency, which is what betting odds are predicting right now, a Trump presidency. He thinks all of that's only going to help small caps. So let's listen to him for a second.
There's a lot of opportunity in small caps. Part of it is that there's a lot of overlap. When the Fed cuts, that's lowering cost of money. That's good for small caps and the regional banks. It probably boosts CEO confidence, which is M&A, and that benefits small caps. So there's a lot of overlap between a Fed cut imminent and a Trump White House, and that's why I think the interplay is positive for small caps.
So I still feel like, these two competing forces that, hey, there's this macro that's saying, hey, we might rise, and then then the loss ratio and just EBITDA guidance potentially sort of pushing it downwards or making the reaction more of a bearish reaction. But I don't know. I mean, again, going back to, I think, the loss ratio, I still feel like if it's in the 80s, it's not that bad. The market might say, hey, that's not terrible. It was a bad quarter for CAT for everybody. We give you a pass on that, and maybe adjusted EBITDA is not as bad. Maybe it shifted around more between Q2, 3, 4 than I was sort of predicting, and so the Q3 is not quite as bad looking. Q4 is not quite as good looking, but maybe again it's sort of a neutral pass. I mean, that would be great for me if we formed. Ideally, if we form like a new base in the 20s here, and then suddenly Q3 or 4, we just that's a rocket ship moment out of this new base. I mean, I'm totally fine with that because for me, I always sort of rest my own thinking and my own thought always goes to the long term. Like, no matter what happens each quarter, we can try and think about that and predict that. But what's the long-term thesis really going to tell us? The long-term thesis for me can really be boiled down to just a couple things. What's their lifetime value to customer acquisition ratio that they're getting? And lifetime value is just all the gross profits. This equation here calculates all the gross profits of a customer or customer cohort over their lifetime. All those gross profits divided by whatever you paid for the customer gives you your LTV to CAC, right? And I think the LTV to CAC is like Lemonade said it was over 4, but I think it's like even they're being conservative of how they calculate that, and it could be argued it's 5, 6, even higher than that because you get customers for so cheap, even $135 a customer, really cheap. Then you can grow with the customer over time, and this is all driven by the technology that Lemonade is using to make all their processes more efficient. You can't serve a customer as well. You can't in a renter's or a pet space if you're not hyper efficient in handling their claims and onboarding them and all those things. So the LTV to CAC as well as their operating efficiency. Those two things go hand in hand. So the operating leverage that Lemonade has. So this graph shows their in-force premium and their total operating expenses over time. As you can see, premium continues to rise. Operating expenses have basically stayed flat for the last few years. And I think this trend is going to continue. They're technology enabled to continue pushing this trend and cut out agents, cut out customer service representatives, and do the same or better job as what humans could do, but in a more automated, much less expensive way. So that's my theory on the operating side. If that continues, this operating leverage, that's great. You checked box 1 of 2. And then if your LTV to CAC you can prove is really healthy amount, like generally a 3 or higher is sort of considered good, but 5 or higher is excellent. And I think we improve very easily. It's 5 or even higher than 5. And I've covered this in other videos, but if you assume a customer comes in the door or a cohort of customers at $315 per customer, that's where they start at. And their lifetime gross loss ratio, so not individual quarters, but for that whole cohort for their whole lifetime, even as customers churn away and you ignore those ones, then the best customers stay. You say it's 65%. Now, in Lemonade Investor Day, they thought it would even be going lower than this value, but as a lifetime gross loss ratio. But say it's 65%. Annual dollar retention, which factors in people churning, but people also upselling or cross-selling to higher products, so it factors in both of those effects. 90% we'll say. And say give the time value of your money as a 5% value, whatever you want to pick there. And say you spend $135 per customer. You have LTV of 771, LTV to CAC 5.7. Say this is only 110. Say they spend less per customer. Then you're having like an LTV to CAC of 7. Huge, huge, huge value. Legacy example, let's say the only difference here in this equation is that I say, hey, rather than just spending a set CAC cost up front, you spend say 10% of your IFP over the lifetime of the whole customer. So every single year, if somebody spends $2,000 on their car insurance plan, $200 goes to the agent who made that sale for the rest of the time. until they, cancel or go somewhere else. So you plug those numbers in, say it's $2,000, whatever the value is, and say it's the same values as above. Gross loss ratio, lifetime, say 65%, 90% annual dollar retention, 5% time value of money. Now this side adds 10% for your cost of your IFP commission and calculates your CAC for this customer at about $1,400. But their LTV, I mean, this is a $2,000 policy starting out of the gate for like a bigger home or car insurance policy. The LTV to CAC is, 3.5. 3.5. So not bad. I mean, obviously it's a model that could work. 3.5. But this is versus maybe 7, maybe 6, 7 for Lemonade. And say even if this was more like 15%, it can vary in how this, terms would be structured. Well, now you have LTV to CAC of like 2.3. So this is your legacy example. This is how a lot of people model. They're fighting in auto insurance, home insurance, and they have LTV to CAC of 2.3. It's not that great. Maybe even, maybe 3. Somewhere 2 to 3.5 maybe. Well, Lemonade, it's like, my mind, it's easily, let's say maybe this is $125 for a customer they spend. It's easily like 5, 6 sort of range, somewhere in that range. And like, this math does not lie. I am 100% certain that this math, what we're doing here, if you don't understand this math, because I've realized I've shared some of this and people on Twitter have been like, some of the questions people have asked have been like, you clearly do not actually understand what this summation series is doing in how this sort of boils all this math down really simply to this. But this could be another video where I try and sort of illustrate that a little more clearly. But LTV to CAC is huge. They're spending $1. They're going to get $6 in present value back for that dollar. So if they just keep turning that flywheel, and they still have, I mean, this doesn't factor in your operating leverage or the operating expenses side of things, but if they continue to have really low, flat operating expenses, relatively flat, it'll rise a bit as they spend more on customer acquisition. But as they keep that flat relative to the top line growth, it's only obvious where this is headed. It's like, it's going to be wildly successful. And you notice how like the things I'm talking about here, I'm going on a bit of a rant. It's like, they're not like wild, like, hey, if they solve this insane problem and go to the moon and then to Mars and, come back, then we'll be successful. Of what they are doing, we know they for sure are doing is cutting out the cost, saving on operating expenses, offering the same or much better product at lower prices to customers, especially in the home and pet insurance space, so that they can get and acquire these customers for $125 instead of, $1,400 over the life of the customer that Legacy is spending. Of course, they're getting a lot more premium for that, but they're still spending $1,400. Well, Lemonade's spending, $100 and something. And they're lower premium to begin with, but then these snowball and grow over time as these customers upsell. Like that's the whole thesis. And it's, again, the point I'm trying to make is it's not like jumping, it's not like, first they go to Mars and then they come back and then we'll be successful. It's not like these wild, huge assumptions. I think they're very, very solid assumptions. There's other things on top of that, top of the thesis, or you can be like, maybe can they perfectly cherry pick customers, or how well can they do that, or differentiate, how granularly can they perfectly separate one customer from another. Those are like extra bonuses that could make this go even crazier, but they're not required necessarily. They're not fully required for the thesis to like be a slam dunk. So that's my little rant on how I see what's most important with the thesis. And finally, I just want to leave you with this little valuation model, which I covered in one of my last videos, where I say, hey, really simply, if you plug in numbers for your gross loss ratio, in-force premium, growth rate of premium, operation expenses ex CAT, and the growth rate of that, and your IFP to CAC ratio, annual dollar retention, and the amount of share dilution, and discount rate. You plug in all those numbers, and you can just pause the video and have a review of these. And you push that out into the future, and then you give it some PE value of, I have it like at 60, all the way down to 15 by, the late 2030s. You can push that out and say, hey, the present value based on each of those years, if you look back, the present value today is maybe, you could argue it's $70 all the way to like $130 some dollars per share is what a good present fair value would be right now for the stock. Again, this is what I also hang my hat on as a long-term investor. It says, hey, I think there's a huge margin of safety. I think at some point the market will catch on. We'll have a rocket ship moment. Will it be this quarter? It'll be an exciting week ahead, and we will find out. Thank you so much for watching. Remember, it's in the bag.